Yes, sir.
Secretary of the Visakhapatnam branch, C. Anirban Prasad, and a learned speaker, our dearest friend, K.Ch.S. Guru Prasad garu, today's speaker, and our senior members, and my dear MC members, other dignitaries, a good evening and welcome to you all. Because every year we are eagerly waiting for this CARO 2020 because we have seen the changes in 2016 and 2020 also. Now, the central government in exercise of the powers confirmed under Section 227(4)(a) of the Companies Act 1956 has issued CARO, which has been undergoing changes since 1988. The order contains certain matters on which the auditors of companies have to make a statement in their auditor's report. In exercise of the powers confirmed by subsections 11 of the Section 140 of the Companies Act 2013 and supersession of the Companies Auditors Report Order 2016, Companies Auditors Report Order 2020 brings more enhanced reporting disclosures, which will provide more accurate insights to the business with completeness and accuracy, providing the stakeholders knowledge about the operational and financial position of the company. Such enhanced disclosure will provide foreshadow about corporate failures before the actual collapse. The onus of comprehensive disclosures lies on both the auditor and the auditee concurrently. The key changes in CARO 2020 include the additional comment to be made for intangible assets. The term materiality has been defined in CARO 2020, that is 10% or more, which was left to the auditor's judgment in CARO 2016. The ambit of financial transactions has been widened enough to include loans given to any party, which was limited to parties covered under Section 199 register. So, reporting of the transaction not recorded in the books of account have been surrendered or disclosed as a newly inserted paragraph which requires reporting on CSR, income surrendered, and complaints by whistleblowers, quality of the internal audit, consideration of the issues, objections, or concerns raised by the outgoing auditors, etc. So, with these few lines, I welcome you all to this webinar. And before going for this webinar, I request Sridhar Garu to introduce today's speaker. Attention to Sridhar. Unmute change, sir, Sridhar Garu.
Good evening, members. It's my privilege to introduce CA Guru Prasad Garu to today's evening virtual meeting. CA Guru Prasad Garu did his entire education from our own Visakhapatnam. He has completed his graduation in commerce from BVK College, Andhra University. He is a table tennis player and won many tournaments in under 19 category and won inter-college championships for 2 consecutive years. He had done his articleship from Mrs. Ravan Kumar and joined the same firm as partner after having completed his CA in the year 2004. He has also completed IFRS certification course conducted by ICAI in the year 2010. He is an honorary member on the board of trustees of Dhanishta Foundation, a non-profit organization that works for social upliftment and distribution of divine knowledge. He is an honorary member on the Board of Trustees of Dhanishta Foundation, a non-profit organization that works for social upliftment and distribution of divine knowledge. He is an honorary member on the Board of Trustees of Bala Bhanu Vidyalayam Trust, a non-profit organization that runs a school in Muralinagar, Visakhapatnam, with the main objective of imparting ancient Indian values and tradition among with education. Just 1 second, sir. 1 second.
Thank you, Sridhar Garu. Now I request Sri K.Ch.S. Guru Prasad Garu, please take up the session, sir. The floor is yours, sir. Guru Prasad Garu.
Sir, good evening. I think Mr. Sridhar is still
Could
continuing.
you sound pencil, sir? Please, sir.
So, sorry. Sir, 1 second, sir. 1 second. I have a network problem. I logged in from two devices. One is giving echo. Yeah, I'm sorry. I'm just repeating the introduction of C.A. Guru Prasad Garu. C.A. Guru Prasad Garu, he has completed his entire education from our own Visakhapatnam. He has completed his graduation in commerce from BVK College, Andhra University. He is a regular table tennis player and won many tournaments in under-19 categories and won inter-college championship for 2 consecutive years. He did his articleship training from Mrs. Ravel Kumar and joined the same firm as partner after having completed the CA in the year 2004. He also completed IFRS certification course conducted by ICAI in the year 2010. He is an honorary member on the Board of Trustees of Dhanishta Foundation, a NPO that works for social upliftment and distribution of divine knowledge. He is an honorary member on the Board of Trustees of Bala Bhanu Vidyalayam Trust, a NPO that runs a school in Muralinagar, Visakhapatnam, with the main objective of imparting ancient Indian values and tradition along with modern education. He is a director on the board of Kanaka Mahalakshmi Cooperative Bank Limited. He visited and participated in various seminars and activities of World Teacher Trust Global conducted at Switzerland, Spain, Germany, Italy, Austria, Belgium, France, England, Greece, Israel, Argentina, and Brazil by the World Teacher Trust, a global non-profit organization. He is son of none other than our Dr. C.A.K. Parvati Kumar Garu, a renowned and well-known personality in Visakhapatnam. He happily married to Srimati Gayatri Garu, BR by qualification, and is blessed with a daughter and a son. With these few words, I introduce C.A. Guru Prasad Garu to the August Gallery. Over to Chairman. Thank you, sir.
Thank you, Sridhar Garu. Now I request our K.Ch.S. Guru Prasad Garu to take up the session, sir. The floor is yours, sir. Guru Prasad Garu.
Thank you, sir.
కొంచెం గురుప్రసాద్ గారు కొంచెం సౌండ్ పెంచాలి సార్.
1 minute and let me check. ఇప్పుడు ఎలా వినిపిస్తుంది సార్?
ఓకే సార్.
ఓకే సార్. Respected Chairman of Visakhapatnam branch of SIRC, Sri Vasudevamurthy Garu. Respected Treasurer of Visakhapatnam branch of SIRC, Sri Sridhar Garu. Respected Secretary of Visakhapatnam branch of SIRC, Sri Anirban Pal Garu. Sri Gurti Subbarao Garu, esteemed member of Visakhapatnam branch, member of institute and past chairman of Visakhapatnam branch. I recognize his presence in Zoom. A very good evening to all the members that have joined this session. The subject that has been given to me is very relevant for the year to come, because there have been so many changes in CARO 2020. There are about 21 clauses in the new CARO. where there are 7 new clauses that have been introduced in this CARO, while 10 clauses have been modified and 4 clauses have been left without change at all, and 1 clause has been deleted as compared to CARO that was previously in existence, which was CARO 2016. CARO 2016 and amendments in Schedule 3 of Companies Act in all 3 divisions, Division 1, 2, 3, are very relevant to us because all of them are going to get applicable from 1st April 2021. That would be reporting balance sheet as on 31st March 2022. We should be applying all the amendments of Schedule 2, Schedule 3, as well as the CARO that we give should be CARO 2020, which is a new CARO, which has come into effect by superseding CARO 2016. So this is very important to us because the topics that were brought out as amendments in Schedule 2, as well as topics that auditor has to report in CARO, are very significant ones. And then there are many important aspects which auditor has to take careful study before he makes a comment in CARO. There are very big commitments that we give in our report. A lot is expected of auditors. When we see these amendments, we are just put next to the seat of Almighty, where we are even expected to foresee what would happen to company in the next year to come. So there are clauses of such implications. So utmost care needs to be taken while reporting the issues. So all the issues that we report, we need to make a close study, close audit, review, gather adequate documentation, make a professional judgment, and report the same in CARO. All these points that we are going to discuss have serious implications if there are any misreporting that we do in CARO. This is only a word of caution, not to scare the members of what would happen to the members if there is a wrong reporting, because every one of us know what are the guidelines that we have and what are the stipulations that we need to follow, and disciplinary actions that would come to our doorstep if there is any misreporting or wrong reporting that we do. So thank you very much, sir, for having considered this topic and having considered me to speak on this topic. I'm not a regular speaker on the panel of CPE seminar. On and off, I have been speaking for students, but this is probably second or third time I'm addressing the members. Thank you very much for considering me. So initially, when the topic that was given to me, it was given as to discuss all the issues of CARO 2020. But later on, there have been a couple of requests from members where they also wanted me to cover amendments in Schedule 3. So what I have done is I have done a correlative study, because there are many points that have come as amendments in Schedule 3 have correspondence in CARO 2020, where auditor is required to comment on such issues. So what I have done is I have made a correlative study and prepared the presentation and also prepared the topic in such a way so that parallelly we cover both, which would be CARO 2020 amendments as well as CARO 2020 as well as amendments in Schedule 3. So I'll just start with the presentation. We will slowly flow through the presentation, and if there are sufficient time would have probably been allotted by the organizer for question answers. Sir, if you permit me, Vasudeva Murthy garu, I'll go ahead with the presentation, sir. Thank you, sir. CARO 2020 and amendments to Schedule 3, a correlative study. Let us see the history of CARO. Vasudeva Murthy garu has rightly pointed as where the CARO journey has started for us. It started with CARO 1988. Most of us have started our career with it. Way back in 1988, manufacturing and other companies auditors report order, which came into force in 1988, and there were 24 clauses. And then CARO was superseded, and then CARO 2003 has come into picture with 21 clauses and 18 sub clauses. Then later on, it has been CARO 2015, 12 main clauses and 10 sub clauses. CARO 2016 has come into force, and then there were 16 main clauses and 8 sub clauses. And we have traveled all the way from 1988 to 1920, while there were many changes in the CARO, and now we are at CARO 2020, 21 clauses and 37 sub clauses. Much is expected of us, so there is no doubt that CARO 2021 or 22 would come very quickly, because the expectations on auditors are increasing by the day. The responsibility on the auditor is getting increased by the day, and then we also have to pull ourselves up and then prepare ourselves to meet the expectations. So the Schedule 3 amendments and CARO 2020 points are more or less points of propriety aspect, where information is required by the stakeholders, and all such points are very relevant as far as stakeholders are concerned, and then while studying the financial statements together with the auditor's report. So let us go ahead. There are 7 new clauses, as I explained. The 7 new clauses are pertaining to CSR, then financial position of the company, auditor's resignation, aspect on cash losses, aspect on internal audit. Auditor is required to comment on internal audit system. Auditor is also required to comment on unrecorded income and also make a comment on CFS. Earlier CFS, in CFS companies consolidated financial statements, CARO was not there, but now on CSS also only one point as far as CARO is concerned that auditors are required to report, which is point number 21, where all the subsidiary companies and JVs that have been consolidated in CSS, respective companies auditors, if they have reported anything under the CARO report of those respective companies, the consolidating auditor has to consolidate all those points company-wise and present it. That would be the CARO for the consolidated financial statements. So point number 21 is exclusively for consolidated financial statements. Point number 21 of CARO 2020. All other 20 points are for standalone balance sheets of companies. So let us discuss in detail. I'll just go step by step. The first point is applicability. From when is CARO 2020 becoming applicable? In February 2020, NCA has come up with a notification where it has said that CARO would become applicable from 1st April 2019. Then later on, in 24th March 2020, another notification has come, and then the applicability of CARO 2020 has been deferred by 1 year. Later, one more notification on 17th December 2020 has come, and then the applicability has been deferred by 1 more year. So if you read through all the notifications, CARO 2020 is becoming applicable from financial year 21-22. Just give me a second. I'll just switch from my mic to a wired mic so that the audio level might improve, as members are suggesting that I need to change my mic. Just give me a second. Hope the volume level is good now. Sir Vasudevamurthy garu, the level of audio is good now.
Sir, kuncham sound penchal sir, kuncham.
వాల్యూమ్ ఆన్ సార్, మీరు మీ దగ్గర చూడండి. చైర్మన్ గారు బాగానే ఉంది.
Okay, sir. So I'll go ahead. So when we read through these notifications, February
sir.
2020, March 2020, and December 2020, we get to understand that CARO 2020 is applicable from financial year 21-22. As far as applicability of CARO to companies are concerned, there is not much of a change from CARO 2016. The exceptions list is same as 2016. The applicability of CARO 2020, it is not applicable to banking companies. It's not applicable to insurance companies as defined under Insurance Act 1938. Section 8 companies are also kept out of compliance of CARO 2020. One person company and small company, private limited company. And with respect to private limited companies, which are not subsidiary companies or holding companies of a public company, and paid up capital and reserves or borrowings of from banks or financial institutions, if it is not more than 1 crore, or if total revenue is not more than 10 crores, then the private company would be exempted from reporting under CARO 2020. So if you see, pretty much the applicability to companies is exactly the same as CARO 2016. There is no tinkering as far as applicability is concerned with regard to companies. The first and foremost point that we have is property, plant and equipment. What I have done is, for the benefit of to save more time and then to elaborate on points that are of concern, I have excluded from presentation points that are repeating from 2016. So points that are already existing and then that are continuing some from 2016 into CARO 2020, I'm not deliberating on them. I am only deliberating on the new clauses that have come into CARO 2020 as compared to CARO 2016. So when we look at CARO 2020, the first change that we see in the first point is that terminology change. This terminology change from fixed assets to PPE is more in line with the terminology used in Ind AS as well as revised fixed assets accounting standard 10. Ind AS 16 and Ind AS 116. The terminologies have been borrowed from there. And to match this, there has been also an amendment in Schedule 3, where on the face of the balance sheet under non-current assets, we were having the word as tangible assets, which has been replaced to PPE, which is property, plant and equipment. And in Schedule 3, after PPE, intangible assets also have to be disclosed separately. It has also been included. And in our CARO reporting as well, we will also have to include intangible assets as well. So for intangible assets and PPE, we normally report whether records are being maintained for the purpose of fixed assets registered with all particulars, whether it is being maintained or not, whether proper records are being maintained or not, including quantitative details, situation of the fixed asset, and so on and so forth. CARO did not specify as to what records are to be maintained, but the institute guidance note pretty much gave us all the items that are to be present in the fixed assets register. Only then we would consider the asset register as complete. As an auditor, I would like to also mention that instead of giving just yes and no answer in our CARO, the stakeholders would have greater information and then they would appreciate greater information in our reporting. So as far as possible, in my view, we should be dealing with all these points by giving an elaborate answer, not to run into hundreds of pages, but instead of just yes and no and not applicable, it would be rather beneficial to the reader of the report if it is little elaborative as to what we are considering while reporting that particular aspect in our report. One more new point that has come under the first clause is reporting on the title deeds. Auditor is now required to comment on existence of title deeds for all immovable properties. So what are we to do now? If you see, when we were doing PSU audits, we were given subdirections by C&AG, where for PSUs we were also verifying the immovable properties title deeds. and then commenting exclusively to C&AG about existence of title deeds. Similarly, now even in CARO, for all companies, now we are required to verify the title deeds of all immovable properties, and then we will have to comment if those title deeds are existing or not. If there are no title deeds, then we need to give details in specific format which has been stipulated in CARO 2020. In line with this CARO requirement, Schedule 3 also there is an amendment where company is to disclose details of all immovable properties where title deeds are not in the name of the company. So the disclosures that we give are like this. CARO 2020, Schedule 3, more or less both the tables are same. Description of the property, gross carrying value, in whose name is it held if it is not on the name of the company, whether promoter, director or their relative or employee, if the holder, if it is a promoter, director or a relative or an employee, period held indicating the range wherever appropriate, reasons for not being held in the name of the company. This is what we are required to report. Under Schedule 3, it is same relevant line item in the balance sheet, whether it would be property, plant and equipment or investment property, or PPE retired from active use or any other line item of its immovable property, gross carrying value, title deeds held in the name, in whose name is it being held, whether it is being held on the name of promoter or a director, then period of holding since which date. That is what is different from what is we have to report in CARO. In CARO, we have to report, indicate the period held. Here we have to give the dates from when till when, and then reasons as to why it is not being held on the name of the company. In case it is because of certain disputes, we also have to mention details of those disputes because of which title deeds are not on the name of the company. So while we are verifying title deeds, auditor would normally come across various instances where title deeds are not available. For example, a company which is incorporated in 78, 79, properties purchased in those times, records would have got destroyed or certain documents are not available, misplaced. So what is the responsibility of the auditor in that case? Because we very well know that the land or immovable property is in the possession of the company. Company is using the same for its operations, but the title deeds are not available. So that doesn't mean that the company does not have title. So in our regular balance sheet audit, we don't report that. But in CARO, since we are required to specifically comment if the title deeds are available or not, in my view, we have to report it. For all cases where the original title deeds are not available, we also have to check what are the steps taken by the management. We have to take management representation as to steps taken by them. If knuckles have been obtained from respective sub-register offices. And also if the photocopies are available, it is better that we have them authorized by the management and then take a copy of the same if the photocopies are being relied upon. And mention the same in our report as well, and also indicate why those documents are not available. So that is one way of handling it. And then in many instances, the land or immovable properties, other immovable properties would have been given to banks or financial institutions under mortgage. So title deeds, original title deeds won't be available with the company. In such case, we can obtain the statement from banks or financial institutions declaring what title deeds are surrendered to them. In certain states, online records can also be checked, and then we need to also check the online records and see if the title is on the company or not. And then if the documents that are given to us, as well as the declaration from financial institutions, banks, if they are in line with the line items of the fixed register, then probably we don't have to report those cases. This is my view. Every auditor can take an independent view on the matter. If disclosure is considered necessary, it is always good to give a disclosure there. So this is one issue probably we might come across. Likewise, there can be a case where company got amalgamated or merged, new company has come into picture. And these companies, mostly they are new companies come into picture after a court order. So in the court order, normally the assets that were there on the name of the erstwhile companies would be mentioned. in which case we don't have to insist on transfer of the name from the old company to the new company. So all those cases also, in my view, we can take the necessary documentation for our working paper purposes and then not required to report. So such are the cases we might come across when we check the title deeds. So the reporting requirement is existence of title deed, whether it is there or not. If not, we need to report as per the specified format provided by CARO. The same is required by Schedule 3 as well. Their management also has to report. The next point is revaluation. In the first point of property, plant and equipment, revaluation is also brought in. Auditor is now required to comment whether revaluation of PPE has taken place during the year. Then he also has to comment whether valuation has been carried out by a registered valuer under Companies Act 2013. In case of each class of PPE, if there is a change in carrying value by more than 10%, auditor has to specify the amount of change. Each class of PPE is basically land and buildings can be one class, and then plant and machinery can be a class. So each class of fixed assets, if there is a revaluation carried out, and then if the revaluation, in the revaluation there is a change by more than 10%, then we will have to disclose the details, specify the amount of change. And this clause is applicable, in my view, only to companies that have picked revaluation model to arrive at the carrying value of PPE. As everyone is aware, in India AS 16 as well as AS 10 revised, for measurement purposes, to state the carrying value in the balance sheet, companies have the option of picking either cost model or evaluation model. This point would be applicable only to companies that have picked revaluation model, as under cost model revaluation is not contemplated. Likewise, as an insurance, because in CARO we see there are all these points where we are required to report. We are relying on the facts that are presented to us during the course of the audit, and also documents that we have verified. And then we are arriving at these calculations. So as an insurance, this Schedule 3 amendments are welcome because they also provide certain calculations from the management end. All the figures that we give in our CARO report are also being given in Schedule 3 in the balance sheet by the client. So there is a facility where you can cross-verify our figures with the management figures. So in Schedule 3 also, in the fixed asset schedule that we normally give, there is an amendment where if there is a revaluation carried out, the company has to specify the change in the net carrying value in case of each class of asset where the change is more than 10%. This includes also return of right of use in case of leased out properties, as well as intangible assets. This has to be disclosed as part of a fixed asset schedule. Under additional regulatory information, the company is also required to state the fact whether the revaluation has been carried out by a registered valuer as defined under Companies Act 2013. So as far as revaluation is concerned, CARO, we have to report these facts, and then company also reports the same facts in Schedule 3. Under the first point itself, Benami properties have also been introduced, where auditor is now required to comment on Benami property. Basically, Benami property under Benami Transaction Property Act 1988, everyone would have updated themselves up to what would constitute a Benami property. It is not just restricted to immobile property. It goes up to even rights, intangibles, as well as loans and advances. Everything under the sky, which goes on to the asset side of the balance sheet, gets covered under this Benami transactions. So this is something that we need to look in. As a part of audit, we normally check if there are any Benami transactions during the course of audit. If something gets picked up, and then if there is a suspicious transaction, and then we conclude that it is a Benami transaction, this is not placed to report it because CARO is contemplating only on transactions where there has been initiation of proceedings by respective authorities. Only on a Benami transaction, if a proceeding has been initiated, only in such cases we need to report in the CARO. So if there has been a Benami transaction and a proceeding has been initiated, we have to report whether the transaction has been appropriately disclosed in the financial statements. So what is it that the financial statements have to report? Schedule 3, there is an amendment where company has to give details of property, including year of acquisition, amount involved, details of beneficiaries. In a Benami transaction, there is a Benamidar and there is a beneficiary. Benamidar is the person on whom the property is actually registered, but beneficiary would be the beneficial owner of the property. So here we have to give details of beneficiaries as to who is considered as beneficiary in the Benami transaction. If the property is in the books, we also have to give reference to the line item in the balance sheet. The company needs to disclose that as well. If the property is not in the books, the company also has to state the fact as to why it is not there in the books while the proceedings have been initiated. The proceedings against the company under law as an EBITDA, transaction or transfer, then details shall have to be provided where proceedings against the company under the law as an EBITDA of the transaction or as a transferor. In both cases, we have to give details. Nature of proceedings, status of the proceedings, and company's view on the same. There can be proceedings that could have been initiated, but companies of the view that it is not a Benami transaction. So the company has every right to state its view on the matter. So that is what the disclosures of Schedule 3 are, which the company has to disclose in its financials. Now in CARO, we need to report whether the company has appropriately disclosed the same in the financial statements. Likewise, if there is a penalty, and then if we go through the proceedings and status of the proceedings, and if we are of the view that there would be an implication in the case, then we need to check if there is a liability that we need to recognize in the books. Otherwise, whether contingent liability disclosure is sufficient. And one thing that we need to take care here is this reporting under CARO is only required if the proceedings have been initiated with the company as the Benamidar. Suppose if the company is a beneficial owner, then this point is not applicable. In CARO, we don't have to report that. The reporting requirement only is with regard to company as Benamidar in a Benami property. So this is as far as Benami transactions is concerned. We'll move on to the next point. With regard to inventory. Earlier in the inventory, we were only required to state whether inventory there is a verification of physical verification is being carried out or not, whether this material discrepancies have been taken care in the books or not. But now in the CARO 2020, additional points on which that the auditor is required to comment is on the coverage of verification, whether it is appropriate or not, and also procedure for verification by the management, whether it is appropriate or not. What is coverage? Coverage is basically how much inventory is being covered under each category of inventory, and procedure of verification. And then we have to see, normally in companies, small companies, we see that only stores manager gives a certificate where he says the physical verification has been carried out and no discrepancies are identified. That is not a procedure. Procedure basically is that a company should normally have a physical verification policy. Policy should mention who would be the team members for verification, what are the formats of verification sheets, who have to draw those verification sheets, and then who should authorize those verification sheets, and then what are the shortages, excesses reported, confirmation by the same by the respective authority in the company. So there would be some SOP or some procedure which ensures that proper verification takes place and then the shortages and excesses are accurately identified. Likewise, damaged stock is also accurately identified. So such is the procedure that a company should normally have. Now we are required to also comment on the appropriateness of the procedures adopted by the management for verification. this is something which is new. Coverage and procedure for procedure of verification we are required to comment. Earlier only we had to say if all material discrepancies have been properly dealt with in the books. But now threshold limit has been specified in CARO 20 itself, where the requirement is if the discrepancy is of 10% or more in aggregate in each class of inventory, then we will have to give details of as to the amount and for each line item. So what are the classes of inventories? Under if you see under AS2, we have raw materials as one class of inventory, components as another class of inventory, work in progress as another component, finished goods, stores and spares, loose stores. So we need to see under each class if there is a 10% change. It is not aggregate inventories. For example, in raw materials and components, if the excess or if the discrepancy is more than 10% compared to the overall inventory value under the component raw materials and components, then we need to report. So for each class, we need to check this threshold limit. So the classes are normally for the companies that where AS2 is applicable, it is raw materials and components, work in progress, finished goods, stores and spares and loose stores. In case Ind AS is applicable to the companies, then the classes would be merchandise, production supplies, materials, work in progress, finished goods, so on and so forth. So as per the Ind AS, the classes are there. For each class, we need to check the threshold, and then if the discrepancy is 10% or more, we need to report. So we also have to say whether the discrepancies have been properly dealt with in the books. If there is an excess, whether it has been properly adjusted in books, whether if there is a shortage, whether necessary provisions or write-offs have been done or not in the books of accounts. So we also need to report whether they have been properly dealt in the books or not. Let's move on to the next point, which is working capital borrowing. This is something which is very important as far as client is concerned, because as we know, working capital limits, the client has to submit periodical stock statements to the banks or financial institutions, and then these stock statements are prepared based on unaudited accounts, and then there could be certain errors that would be there in those statements. But when the company prepares those statements, they verify and then they certify those statements and then submit to banks or financial institutions. Periodically this happens, but at the year end, when the accounts are finalized and audit is carried out, internal audits are carried out, whatever corrections that are required to be carried out, when all those corrections are carried out, then the quarterly statements that are given to the bank may not agree with the quarterly statements as per books of accounts. So those quarterly statements, if they are not agreeing with the books of accounts of respective quarters, then the auditor is required to report under CARO. So if the CARO or Schedule 3 applicability has been already alerted to the clientele, they would have already taken care of this point from the first quarter of 2021. But if this is something that we are intimating client, or client comes to know of it at the fag end of the year, we need to closely look into those discrepancies and see what is to be reported. We have to report. So as far as reporting requirement is concerned, whether the company has borrowed or not is not the question. If there are working capital limits in excess of 5 crores and borrowing is only say 10 lakhs, even then the reporting is required. It is not the borrowing that is to be looked into as far as threshold is concerned for CARO. We need to check the limits. If the limit is 5 crores, in excess of 5 crores, then we need to comment on the quarterly statements that are submitted to banks or financial institutions, whether they are in agreement with books of accounts. If there are discrepancies, then we need to report those discrepancies. Similarly, in Schedule 3 also, company is required to report whether quarterly statements submitted to banks are in agreement with books of accounts. Here there is no threshold limit mentioned. So as far as company is concerned, even there is no threshold limit for them. So even a crore or even a penny is borrowed from the bank and quarterly statements are submitted, the disclosure is required. So they have to state whether quarterly statements submitted are in agreement with books of accounts or not. And if they are not, then company is required to give a summary reconciliation and also provide reasons for all material discrepancies. So the onus is now on us to check whether banks are getting right statements or not. Because as far as company is concerned, as far they would try to give the quarterly statements basing on the provisional statements that they prepare for a quarter, which are unaudited, not verified by the internal auditor or the statutory auditor. So to the best of knowledge, whatever according to them correct, they would have given. But banks would have always relied on those statements and then continue to provide drawing limits to the borrower. So now the additional security is being given to the banks, wherein the auditor has to also comment on the correctness of statements that are given to banks and financial institutions. This is a welcome amendment in Schedule 3, where banks will come to know if the quarterly statements that are being given to them, whether they are accurate or not. So that is something which banks would really appreciate or welcome this amendment. Going to the next point is loans. This is one clause where earlier we were only reporting on loans given to related parties, directors or KMPs, only those loans, whether they are being given at rates of interest and repayment schedules and whether they are prejudicial to the interest of the company or not. These were what we were required to report earlier. But CARO 2020 requires to report entire loans, irrespective of the party to which it is given. So we have to report the entire loan portfolio and then state what is the component of the loan that has been given to subsidiaries, joint ventures and associates. It is not only loans, we also have to report the guarantees that are given, securities that are provided to subsidiary companies, joint ventures and associates, vis-a-vis the loans and advances, securities and guarantees provided to all the outside parties. So that comparative amounts is what we are required to give, as well as a percentage. And further, with respect to loans given for all parties, irrespective of whether they are related parties or not, whether every loan has a proper repayment schedule and then interest has been stipulated in the loan agreements, whether those repayments are happening on a regular basis and whether interest is being paid regularly or not. If there are overdues for more than 90 days, what are the steps taken by the management to ensure proper recovery of these loans and interest? And moreover, we also have to report on the restructurings, if there are any that are given to these loans in the manner of extending the repayment schedule or giving fresh loans to repay the old ones. All these kind of restructurings that take place, if they have taken place, then we have to mention the amount of loans on which restructuring has taken place, and then percentage of such loans, that is restructured loans, to the aggregate loans. This point is not required to report in case of companies which are in the business of lending, but all other companies we will have to report this clause. So the loans, whatever we have been verifying, we have to verify more carefully with respect to every document, loan document, and see what is the repayment schedule, what are the interests, and what is the interest that is prevailing in the market vis-a-vis interest rates given to other loans, whether it is commensurate or not, and if it is prejudicial to the interest of the company or not. So this aspect we are required to verify on all loans that the company gives and then report it in the CARO. Likewise, where loans have been granted with repayment on demand or without any repayment schedule to promoters, directors, key management persons and related parties, company has to disclose in their financial statements. And the disclosure is like this: type of borrower, promoter, director, KMPs, related parties. In all these three line items, we have to disclose the amount of loan, in the nature of loan outstanding, percentage of total loans and advances in the nature of loan. So this is what is required under Schedule 3 as far as loans is concerned, in the balance sheet now companies are required to state if they have given any demand loans to promoters, directors, KMPs and related parties, and any loans given without any repayment schedule, they have to report. As far as investments are concerned, this is also another new subclass. Along with loans and advances, the auditor is also required to comment upon the investments made by the company, whether they are prejudicial to the interest of the company or not. This is more like a proprietary point, where auditor is required to state whether the investment that is made by the company in its subsidiaries, joint ventures, or whatever investments, say current investments or permanent investments, whether all these investments have been made in the best interest of the company or not. If they are prejudicial to the interest of the company, we need to report it. So this is one clause where we need to prepare certain checklists, because we have not been verifying this earlier. So we need to check each and every investment. What is the interest of the company in making this investment? We need to take representations from the company in this regard, assess for ourselves whether there is a real benefit for the company in this. If there is real benefit, if there is no real benefit or not is what we have to check it, that is one thing. But if it is prejudicial to the interest of the company, then we need to report here. If we consider that it is not of real interest, it is not required to be reported. But if it is prejudicial to the interest of the company, these investments are prejudicial, then we have to report in the CARO. So this is a new subclass under loans. Then let's move on to the next one. It's on deposits. Deposits clause, there is no big change. Only the aspect of deemed deposits has been brought. Deemed deposits are basically deposits where under deposit rules, there is an explanation under, one second, I'll just refer the rule. Yeah, under rule 2, clause 1, subclause C, subclause 12, in the explanation, there is a definition as to what a deemed deposit is. For example, in case a company has taken an advance for supply of goods or services, and then it has been more than 365 days that the advance has not been adjusted against the supply. And later on, it is identified that the company has no right or no capacity to provide such service or supply that good. Then within 15 days, that amount has to be returned. If it has not been returned within 15 days, then it is deemed to be deposit. So under that explanation, there are a couple of instances where an amount can be deemed as deposit. So these deemed deposits are also included now in CARO 2020. So we also have to report on deemed deposits along with deposits. What auditor is required to comment earlier remains pretty much same, whether directives issued by RBI, they have been complied or not, whether the requirements under Companies Act, section 73 to section 76, whether they are in compliance or not. And then whether orders of RBI or Company Law Board or NCLT, if there are any orders on the company with regard to deposits, whether there is compliance to those orders or not. This is what we were required to report in CARO 2016, pretty much same. We also have to report the same in 2020, except that we also have to cover deemed deposits in this particular clause. Coming to the statutory dues, the first clause of statutory dues remains the same. The second clause is pertaining to disputed tax dues. Earlier in 2016, we were only reporting if there are any disputed tax dues, and then we were giving details of all those disputed tax dues, under which act they are liable to pay, and then what is the amount involved, what is the dispute concerned, and then the forum at which it is pending, and then the status. So now in CARO 2020, not only tax dues are to be reported, we also have to report other statutory dues. What are the other statutory dues? For example, PF, ESI, they also come under statutory dues. If there are any disputed dues of PF, we also have to report here. So all statutory dues are included now. It is not only disputed tax dues. We also have to report on statutory dues as well. This is one interesting change that has come both in CARO as well as in Schedule 3, unrecorded income. So the company normally determines its income, and then the audits are carried out by internal audit, statutory audit is also carried out, balance sheets are signed. Income is recognized based on accounting standard and company's policy, certainty of realization and whatnot, everything. And the income is sacrosanct as far as the company is concerned. Now later there is suppose there is a scrutiny, or there is a search, or there is a seizure of books of the company, and then there are assessments that are carried out, and certain additional income has been taxed by the tax department. So that is the point where the auditor needs to check whether this is an unrecorded income that has been unearthed by the tax department in their proceedings. So if so, then we need to report. Otherwise, reporting is not required. So how do we know? Because in every scrutiny, 1 or 2 editions, the company agrees, and then they go ahead, pay the tax, and then close the scrutiny. So that doesn't mean that there is an unrecorded income of that particular year. Suppose in 2018, the accounts have been closed, scrutiny has been carried out. There is an addition in the income by the tax authorities to the tune of say ₹1 crore. Now the company would take a decision as to whether it would go on to fight the case or pay the tax and then save the nuisance cost of going on appeal with the Commissioner of Appeals, again taking it up with the NCLT. There is also cost involved in it. So whether the benefit that the company is going to get, whether it is commensurate to the cost involved in fighting that case or not, all these things company would factor in and decide whether they would like to further proceed with the case or not. So the company has protested it at the first level itself, submitted all its submissions as to why the addition is not correct as far as company is concerned, and then it has paid the tax ultimately just to save the nuisance cost, or fighting the case has no meaning in the forums considering the costs involved. In such cases, I think auditors have to take a call, make a judgment, and see if it is not an unrecorded income or if it is an unrecorded income. If we conclude that it is an unrecorded income, then the company has to ensure that that unrecorded income has been properly brought into books of accounts. What is that unrecorded? How do we bring it into books of accounts? We need to see whether to which year the income pertains, and then if it is a prior period adjustment, whether the adjustments have been carried out correctly or not. In case of Ind AS, we also have to state the previous year figures. We have to restate the whole thing. So such are the proper way of handling those unrecorded income in the financial statements. So auditor is required to report whether all such unrecorded incomes have been properly recorded in books of accounts or not during the year. And then in respect of the same unrecorded income, the company also is now required to disclose in its financial statements, because there is an amendment in Schedule 3, where there is a transaction that is not recorded in books has been surrendered or disclosed in the income during the year in tax assessments under Income Tax Act. Then the company has to give those details of those transactions and also state how it has adjusted the same in the books of accounts. There is one exception to this particular requirement, where in this, if the surrendering of income or disclosure of income is under certain scheme of voluntary disclosure, and an immunity clause is there in such scheme where the company is not required to disclose the same, then company need not disclose that particular unrecorded income in the financial statement, because immunity is provided to the same extent. Moving on to the next clause is borrowings and repayments. Whether company has defaulted in repayment of any loan or payment of interest to any lender. Earlier, it was only to banks and financial institutions we were reporting in our Schedule 3 balance sheet. While in the CARO report, now we have to report with respect to any lender. Any lender, if there is a default in repayment of loan or payment of interest, we are required to report in specified format. The format is like this. We need to disclose in nature of borrowing, whether it is debenture or is it an unsecured loan. So nature of borrowing, then the name of the lender. Name of lender is required only in case The defaults are in case of banks or financial institutions or government organizations. Otherwise, we do not have to give the name of the lender. Amount not paid on the due date. What is the quantum of amount that is not paid? We also have to quantify it. The unpaid amount, whether it is principal or whether it is interest, that is also what we have to report. Likewise, we also have to report on number of days of delay for which the amount is unpaid, and company's remarks. What are the company's remarks and what are our remarks as far as this particular non-payment is concerned. So this is what we are required to report. This is a new clause that has come in CARO 2020. Coming to borrowings and repayments, there are also a couple of other new clauses where loans have been utilized. We also have to state whether loans have been utilized for the purpose for which they were borrowed. If you remember, in earlier CAROs, we were also required to report this aspect, whether borrowings have been utilized for the purpose for which they have been borrowed. And also we were required to report whether short-term funds have been used for long-term purposes. So these two things have been brought back in CARO 2020, where auditor is required to comment on utilization of borrowers as well as also comment on the utilization vis-a-vis short-term funds and then long-term purposes. If the short-term funds have been utilized for long-term purposes, we need to report the nature of borrowing and amount which has been borrowed on short-term funds that has been utilized for long-term purposes should also be quantified. Where company has borrowed funds to meet obligations of its subsidiaries, there can be cases where subsidiary joint venture company or associate companies are new companies that do not have immovable property, or they do not have standing so that they can borrow funds. It's always possible that holding company borrows funds for them and then meets their obligation on their behalf. So if there are cases where company has borrowed funds to meet the obligations of subsidiary companies, JVs or associates, we need to report nature of borrowing and amount borrowed in each of such case. So every company wise we have to report. If there are 2-3 subsidiary companies, we have to report each subsidiary company wise as to what is the amount borrowed and then nature of borrowing, whether it is unsecured, secured from bank, or is it through loans from directors or from shareholders. Nature of borrowing is what we have to mention, as well as amount borrowed. That is also what we have to report in the CARO. We also have to check whether company has borrowed by pledging the shares of subsidiaries, joint ventures and associates. We have to check and then report. If there is such an instance, then we have to report all details. What is the value of shares that have been pledged, and then the quantum of loan that has been taken is what we have to see, and then see if there is any default. If there is default, then we have to report the default, that the company has borrowed such and such an amount, pledging the shares of value of such and such a company, which has been defaulted. There is no specific format given here. It is up to the auditor what he would consider necessary for reporting purposes. Moving on to willful defaulters. If the company is a willful defaulter, auditor has to comment there in the CARO 2020 as to the financial institution against which the default has taken place, or any lender. So if there is the company is a willful defaulter, and RBI in the RBI list, if the company's name comes as a willful defaulter, then in the CARO report, auditor has to state the fact that the company is a willful defaulter against such a loan, such and such a loan with such and such a bank. Likewise, in additional regulatory information in the balance sheet, the company is also required to disclose as to the fact that the company is a willful defaulter, and it has been on the list, and then the date of declaration as willful defaulter, and details of default, also the amount and nature of defaults. So these are what the details that are required to be given by the company in the balance sheet. So amount and nature of default. Nature of default would be basically principal amount or interest amount or processing fees. What is the nature of default? Whether such payments have been defaulted, then we have to give the amount, and then the nature of such amount also requires to be reported in Schedule 3. with regard to frauds, earlier we were required to report only whether there has been fraud on the company or by the company, and then giving details of the fraud that has taken place. Now, additional clauses have been included in this particular clause. Auditor is required to comment whether any ADT 4 has been filed by the auditor as per Rule 13 of companies audit and auditors rules, and whether the complaints from whistleblowers, if there are any received during the year, whether they have been considered by the auditor or not. These are the two additional points that we need to comment now. Earlier, we were only checking the whistleblower complaints and then considering them in our audit. But now specifically, we have to say in our CARO 2020, whether we have considered or not. If there are no whistleblower complaints, then we have to state the fact that the company does not have any whistleblower complaints during the year. If there are whistleblower complaints, then it would be suggested that the number of complaints received, and we need to also state the fact whether they have been adequately considered in our audit or not. Moving on to the next point, which is pertaining to Nidhi company. The Nidhi company, two more clauses have been added, sub-clauses, where net owned funds to deposits ratio 1:20 has been met or not, and whether maintenance of 10% of unencumbered time deposits as specified in Nidhi rules, whether it is being complied or not. So these are the two additional points that we are required to report as far as Nidhi companies are concerned. Then the internal audit system. If you remember in CARO 2003, we were required to comment on the existence and on the adequacy of internal audit, provided the threshold limits have crossed. Threshold limits that were mentioned in CARO 2003 were paid up capital and reserves at the 50 lakhs, and average turnover 5 crores for a period of 3 years, 3 consecutive years if it is exceeding. Then in such cases, the auditor was required to comment on the internal audit system. But now in CARO 2020, there are no thresholds given. Auditor is required to comment whether the company has an internal audit system commensurate with its size and nature of business, and also report whether he has considered the reports of internal audit that were submitted for the period under audit, whether the auditor has considered all the reports of internal audit or not. So there is no threshold limit given. It is up to the companies now. If they, depending on the size and operations of the company, if the company considers that internal audit system is required and auditor also considers that the internal audit system is required, then if the audit internal audit system is not existing, then auditor is required to comment on the same, that it would be required, but there is no internal audit in place. So it is up to the auditor's judgment as to the requirement of internal audit here, considering the size of the company and the nature of business, whether internal audit is there or not, and whether it is, if it is there, then whether it is commensurate or not. And auditor is further required to comment whether he has considered all the reports of internal auditor for the period under the audit. Moving to the next one is cash losses. In 2003, this aspect was required to be reported. Now the same thing has been brought back in 2020. Audit is now required to comment on cash losses, whether company has incurred cash losses in the financial year and in immediately preceding financial year as well. If so, the amount of cash losses that it has incurred. So now we are required to quantify the cash losses that are incurred by the companies. So same thing was there even in 2003, where company which has been registered for a period of not less than 5 years and accumulated losses at the end of the financial year are not less than 50% of its net worth, then we were required to comment on the cash losses, but there is no threshold limit now in CARO 2020. So any cash loss that is reported by the company, we have to report in CARO 2020. Auditor's resignation. One more thing as far as cash losses is concerned, there are certain threshold limits for preparation of cash flow statements. So normally client doesn't prepare cash flow statement if there is no statutory requirement. I think, and then cash flow statements are not applicable to the company. Even in such cases, if there is a cash loss, and then if CARO becomes applicable, it is very remote chance where the cash flow statement doesn't get applicable and CARO becomes applicable. I don't think so there would be an instance like that. But we have to report cash losses even in such case. Coming to auditor's resignation, this is altogether a new clause, is where during the year, if there is a change in the auditor, where the auditor resigned, the earlier auditor resigned, and the new auditor comes into place, the new auditor is required to report in CARO whether all issues, objections, and concerns raised by the auditor, by the previous auditor, have been addressed or not. So this could come as, management letters that the auditor would have given previously, or in the no objection letter that we obtain, previous auditor would report certain issues or concerns which he would like to update us. In all those cases, we have to consider whether the same have been properly addressed by the company or not. And then the same is required to also be reported in the CARO. If there has been a resignation by the statutory auditor during the year, auditor is required to report the fact whether issues, objections, and concerns raised by the previous auditor have been considered by us in our audit or not. So this is what we are required to report. This is a new clause in CARO 2020. Moving on to the financial position. This is a very dangerous clause. This is where I said in the beginning of the seminar that a lot is expected of us. We are even assumed that we are almighty, all powerful, where we can also foresee what would happen in the future. We can very well see what is happening with the company, and then the history of the company, and then the ratios, and then what is the financial position of the company, what are its borrowings, and then what are its orders, what are the future prospects of the company. All these things we can assess and analyze. But at that point in time, something we cannot foresee in future, if that happens, then we are in a particular problem as to explaining as to why we have considered that the financial position of the company is good. So here it is like auditor certifying the going concern of the company. So we have to be very careful and then obtain necessary documentation, particularly in cases where companies have heavy borrowings, because there is all the more possibility that such companies might default in repayment of loans, and banks and financial institutions are very stringent now. They are swinging into action very quickly, and in no time company would be considered as a bankrupt company, as not solvent company. So imagine a situation where we have finalized our balance sheet in say September or August, and then we have signed the balance sheet saying that it is a going concern, and then in December itself the company becomes insolvent, and then the company goes on liquidation or under insolvency and bankruptcy court, company gets litigated. Then it is a very difficult situation for us to answer as to what we have taken into consideration, and then how we have considered the company to be solvent. Because now the point is that we need to take care is the period of 1 year is not from the end of the financial year that we need to see. The auditor has to state that there is no material uncertainty on the date of report of the company. From the date of report of the company until next 1 year, that company will be able to meet all its liabilities. So here, suppose on 31st of August, we have given our audit report. Then from 31st August 2022 until 31st August 2023, we are commenting here that the company would be capable in meeting its liabilities. So this is where we have to be very careful. We have to prepare proper checklists, prepare proper documentation. Just in case the company turns insolvent, we have to guard ourselves as to how we have considered, on what basis we have considered the company to be solvent, that the company would run as solvent for the next coming year. So auditor is required to comment whether the company would be solvent for the next year. On what basis can we do this? We can rely on ratios. We need to do a lot of ratio analysis, and then we need to check the aging of all the liabilities and receivables, and then see whether the agings do match with the incoming cash flows versus outgoing cash flows as far as agings are concerned. And then expected realization of financial assets. If there are any financial assets what would be the realizations of those financial assets, and any other information reported in the financial statements. For example, in the board report, what is it that the company is anticipating for the future year, what are the new orders, and then what is the line of business, what is the strategy of the company, and then the knowledge of the board of directors, whatever we know about the board of directors and what their capabilities are. And then also we need to see what are the management plans for the next year that have been discussed in the board minutes. So we have to explain the client that how serious this particular point is. And we have to guard ourselves with a lot of information and then documentation so that we can be prepared if there is a problem in the next year with concerning the company, then we can answer with all the necessary documentation that we have. So this is one point which is very difficult for an auditor, but this is what is expected of by the stakeholders. So this is one point which we have to be very cautious of and prepare our audit plan as well as documentation adequately. In the schedule 3, there is an amendment where company is required to give 11 liquidity ratios. So these ratios, when we are considering the financial position of the company for the purposes of commenting in CARO 2020, we can rely on these ratios because company itself is calculating these ratios and giving these ratios. So in our ratio analysis, we can pick up ratios from here. But strangely, there is no guidance as to what goes into numerator, what goes into denominator. As every one of us know, commerce and accounting, management accounting is an art. Everybody can have their own interpretation of what goes into numerator and what goes into denominator. But it is always suggested whatever formula that the company has considered and auditor has agreed to, it would be better if the formula itself has been disclosed. Even in the formula, in the numerator, if something is not considered or excluded, or in the denominator, if something is not included or excluded, it would be good to report the same so that there is a comparison that can take place from year on year. So now these ratios, when we give, we also have to give comparatives of the previous year. And if there is a deviation or if there is a change by more than 25% in these ratios, then company has to disclose the reasons why there has been a change in the ratio and then adequately report the same in the balance sheet. So this is one amendment which has a link to CARO point pertaining to financial position of the company, where we are required to do ratio analysis to ascertain the financial position of the company. Then as far as CSR compliances are concerned, auditor is required to comment on the compliance with the CSR provisions of the Act. Now, earlier CSR points were basically spend or report. Now it is spend or comply with the remittances. So where a company has an unspent balance of CSR fund, and then the amount remains with the company as on the end of the financial year, then within a period of 6 months from the expiry of the financial year, company is required to transfer the unspent amount to specified funds that are specified under Schedule 7 of Companies Act. Likewise, where amount remaining unspent pursuant to any ongoing project, then within 30 days, company has to transfer the unspent amount to an escrow account. Whether that compliance has been taken place or taken care or not is what auditor is required to report in CARO under this particular clause. So as far as CSR compliances are concerned, if there are unspent amounts, whether the unspent amounts have been transferred to stipulated funds or not, whether unspent amounts are under any ongoing project, whether the same have been transferred to an escrow account within 30 days or not, is what we are required to report there. As far as CSR compliances are concerned, there is also an amendment in Schedule 3 where company is required to disclose certain aspects with regard to CSR. Amount required to be spent by the company during the year, amount of expenditure incurred during the year, shortfall at the end of the year, total previous year shortfalls if there are any, reason for the shortfall, why is the company unable to spend that amount, nature of CSR activities, nature of activities that the company has carried out. Likewise, if the CSR activities are carried out through company's own trust, then we also have to report it as a related party transaction and then explain the same as CSR expenditure through a related party transaction. And then in case there is a contractual obligation to spend any CSR liability with any particular vendor or any particular trust, whether a provision for the liability is made or not. This is what the company is required to report under CSR compliances in their balance sheet. So there is something that the company is disclosing here. There is something that the auditor is disclosing in his report. So there is a correlation between both. The company is disclosing the facts. The auditor is reporting on the same. So there is a CARO amendment which has come first. Then later on, as an insurance, Schedule 3 has also been amended. Company is also saying certain things as far as those compliances are concerned. Now let us move on to purely Schedule 3 changes, because all CARO points, whatever changes that are there, we have covered. One point which is not there in this particular presentation is the point that has been deleted. In 2016 CARO, there is one point where the auditor was required to comment upon the remunerations that are paid to the directors, whether they are in compliance with the requirements of Companies Act or not. So that point is not there anymore in CARO. That one point has been deleted. So that particular comment, auditor is not required to make anymore. So this is one point which I missed out in this slide, so I'm just explaining. So going forward, as far as CARO changes are concerned, all CARO changes have been discussed. Now we are going to move on to slides where only Schedule 3 changes are being explained. In Schedule 3, there is a change where a new disclosure requirement has come, where company is required to disclose percentage change in the holding of promoters. Company has to disclose shareholding of promoters, details of each class of shares, preference shares, equity shares. So what are the classes of shares in which promoters are holding, details have to be given. Percentage change that has happened during the year also, company has to disclose, and it has to disclose in this format which has been specified in Schedule 3. Shares held by the promoters at the end of the year, promoter's name, number of shares, percentage of total shares, change during the year. This is very important because sometimes there could be instances where promoters are holding less than 5% shares, but promoters are the driving force for the company. So when the promoter is holding less than 5% share, then he doesn't get figured in the financial statements at all. So on year, when anybody is analyzing, he doesn't come into the picture at all. So now here, irrespective of percentage of shares that he is holding, we need to present here if there is a change. Suppose if all promoters have gone out of the company, then it is a matter of concern for the financial institutions or any other stakeholders, likewise to the auditors also, what is happening to the company. So this is a very important disclosure where the shareholding of the promoters and changes that are taking place in the shareholders of the promoters are now required to be disclosed in the balance sheet. Trade receivable aging has also been required under new Schedule 3. In the amendments, they have also brought out trade payables aging, where company shall disclose aging schedule as per the details that have been specified. Particulars of MSME, others, disputed MSME borrower payables, and then disputed other payables, less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Earlier we were reporting only for 6 months. Now it is basically we are reporting whether these payables are pending for more than 3 years. So in cases where it is more than 3 years, and in cases where it is more than 2 to 3 years, questions would be asked by the stakeholders. Auditors would also have to check why these details are payables are pending for so long, and adequate notes have to be prepared by taking the reasons as to these non-payments. If there are any disputes because of which these amounts are being unpaid, then we also have to disclose the same in the balance sheet. for sake of clarity, so that the stakeholders are aware as to why these payables are not paid for so long. 2 to 3 years and more than 3 years is a long period for which any person would allow the company to take credit. Likewise, if there are any unbilled dues also, these have to be disclosed separately. These can be less than 1 year or 1 to 2 years. There can be cases where raw materials or equipment has been provided by the supplier, and then the same has been utilized by the company. But invoice has not been sent, bills have not been sent by the supplier due to various reasons. Then the company makes the provision without crediting that particular supplier. So in all cases where unbilled dues are there, also a separate disclosure is required as per the amendment of Schedule 3. Similarly, in case of trade receivables also, aging is required as per the disclosure requirement, where the company is required to disclose for a period less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. For all cases where there are trade receivables which are undisputed, considered good, undisputed, considered doubtful, disputed trade receivables considered good, disputed trade receivables considered doubtful. So in all cases where the receivables are more than 2 years, 2 to 3 years, or more than 3 years, questions would be asked by the stakeholders, surely by the company. So it is all the more better to state few lines in the balance sheet itself to clarify as to why these dues are there for more than reasonable period, which is 2 to 3 years and 3 to more than 3 years. If there are any disputes because of which these receivables are pending, it is all the more better to disclose those details. Likewise, similarly, if there are any unbilled dues from the third party, also those need to be reported separately. There is also additional disclosure requirement as far as capital work in progress is concerned. For years together, we have been auditing companies which are into manufacture sector, where there would be huge capital work in progress. There would be so many projects that the company continuously works upon, and then these projects would be stretching for more than 1 year, 2 years, and then AS 16 interest, we keep capitalizing it, and then the capital work in progress remains to be in capital work in progress without capitalization, and there will be undue delays. So all these years, auditors were reporting wherever if it is required, if there is a project which is to be written off, whether it is written off or not, and if there is a logic why the project is continuing, and even if there are cost overruns or time overruns, there was no specific requirement for the auditor to disclose the same. However, under new Schedule 3, now the company itself is required to disclose as to project wise the period within which the project would get completed. So total project wise, they have to give whether the project would be completed within less than 1 year, the amount involved, 1 to 2 years amount involved, projects of 2 to 3 years which would get completed in 2 to 3 years amount involved, and more than 3 years. And similar disclosure is also required for intangible assets. So in case of project cost overruns and time overruns, as well in balance sheet, company is now required to disclose the facts as to why there has been a cost overrun and time overrun. Reasons have to be disclosed, and the disclosure has to be given in specific format, project wise, less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And details of project where activity has been suspended shall also be given separately. So in case of capital work in progress, where projects are taking long time to complete, if there are time overruns and cost overruns, when the company is disclosing facts in the balance sheet, auditors are also required to comment if there are any undue delays, and then certain write-offs or provisions if the company has been considering or not. If there are such an instances, we have to see if we have to also bring out in the report and the other matters of our statutory audit report. Another important aspect as far as Schedule 3 amendment is concerned is transactions of the company with the struck off companies. This is very difficult because there could be numerous struck-off companies in the list of MCA. Now the company has to check, as well as the auditor has to check, if there are any parties that are struck off, that are in the list of struck-off company is transacting with them. There could be, the balances could be under investment, the balances could be under receivables, the balances could be under payables. So we need to we have to run a check of all the parties of the company, third parties of the company, and cross check the same with the struck-off companies and see if there are any struck-off companies with which company has a pending transaction. So if there are any such pending transactions, then we need to report here. When we report here, and then when we come across such instances, we also have to see from the angle of requirement of any provision in the books of accounts, if there is any receivable or if there is any investment. Because when a company is struck off, there is very less possibility that receivables would get realized or investments would be fruitful for the company. So this check is now important for the auditors because there is a specific disclosure in the balance sheet where auditor is also signing. So the questions would be asked if there are balances with the struck-off companies, if the balances have not been properly dealt with in books. So adequate care needs to be taken if there are balances with struck-off companies. Moving on to the last part, which is changes, charges and the cryptocurrency. So company is now required to disclose in the Schedule 3 whether there are any delays in registering the charges with statutory authority, which is MCA. Any company making a borrowing, if there is a charge registration which is required, the registration of charge should happen within 30 days from the date on which the borrowal has taken place. So if there is a delay in registering of charges with MCA, and now company has to report here and also state the reason why there has been a delay. Cryptocurrency, you know that in India, this is not actually a valid currency. So companies don't deal with cryptocurrencies, but there can be an instance where company has a foreign subsidiary or a joint venture where there are certain cryptocurrency transactions in those companies. And in CFS, those cryptocurrency balances are reflecting in the books of account. Then in such cases, the company has to disclose now the profit or loss on transactions involving cryptocurrency or virtual currency, amount of currency held as at the reporting date. Likewise, if there are any deposits or advances from any person for the purpose of trading or investing in cryptocurrency, the company has to give suitable disclosures. So this, in my view, wouldn't be applicable for standalone companies, but in case of consolidated financial statements where there are foreign subsidiary and joint ventures, and in cases where those joint venture subsidiaries and associates have transactions in cryptocurrencies, then this disclosure would come into play. So this is the end of the presentation as far as CARO changes and the Schedule 3 changes are concerned. Sir, if there are any questions from the members, I would be more than glad to take.
Members, please respond, sir. If you're having any if you need any clarifications or any questions, then you can unmute yourself and ask. Members, please respond, sir. Any doubts or clarifications, you can unmute yourself and you can ask. Sir, I am having one doubt, sir, regarding the cryptocurrency. This is it is announced now. How to valuation to be shown cryptocurrency in this disclosure, sir? Schedule 3.
If there is a cryptocurrency in the balance sheet of the subsidiary company, we need to disclose that particular value here, sir. But as far as valuation of cryptocurrency is concerned, there is no guidance on that as to what value it would constitute. But since it is a financial asset, whatever is the prevailing rate as on 31st March for that particular currency, that value needs to be considered as far as my view is concerned, because this is a financial asset of the company and the cryptocurrencies are basically meant for trading. So the value as on 31st March, as on the date of balance sheet, we need to check with the market and then value the same. And then if there is any loss or profit on that particular valuation, it has to go as a charge to profit and loss account.
Sir, is there any changes after the announcement of the cryptocurrency in the budget? Because the finance minister has announced regarding the cryptocurrency profit, etc. Is there any change? Then is there any impact in this or changes to be shown in this CARO 2020, sir?
CARO 2020 cryptocurrency is not contemplated. Nothing needs to be reported in CARO, but in Schedule 3 cryptocurrency details need to be given. So if there are cryptocurrencies, then what is required to be reported is only what is the impact on the profit and loss account of the company, and also the balance as on 31st March, whatever is there in cryptocurrency, we have to give currency wise details, or any virtual currency. We have to give currency wise details as to what is the value as on 31st March, and then charge to profit and loss account on account of the cryptocurrency transactions is what we are required to disclose. Otherwise, there is no further disclosure to my knowledge which is required now.
Sir, within the short notice that we accepted our invitation, really we very much thankful, sir, Guru Prasad Garu. So your deliberations are excellently well, but even then we ask some question. This because people are not asking means they received well your deliberations. They understood well because in detail, in step by step, and you covered all aspects of this CARO 2020 excellently well, sir. Now I request our Secretary Garu, Anirban Pal, to propose a vote of thanks.
Good evening, dear members. We are coming to the close of this session of presentation by CA Guru Prasad, my partner and my friend. On behalf of the Managing Committee and on behalf of the members of the Institute of Chartered Accountants of India, Visakhapatnam branch, I would like to thank Guru Prasad for having accepted our request and for taking up this topic on CARO and Schedule 3, which is quite relevant at this point in time. I really thank him for his detailed coverage of the CARO and the related amendments in Schedule 3 for having correlated both these areas, because it is essential to know that the CARO as well as the Schedule 3 are now casting a greater onus and responsibility on both the auditors as well as the companies. So therefore, for auditors, we need to know what is being disclosed in Schedule 3, because there will be management involvement in those figures, as well as the auditor's responsibility in terms of CARO. So I really thank Guru Prasad for having explained to us in detail the new additional disclosure requirements in CARO, the statements or the confirmations that the auditors have to give, which also are appearing in Schedule 3. So those repetitions in both the areas have to be, the figures have to be matched. So he has given us a guidance on that, and also he has given us critical guidances on the areas of significance and the areas of risk that an auditor has to be cautious about. I really thank Guru Prasad. We would request him to again visit us and have a physical meeting whenever the opportunity permits. I would like to thank him on behalf of the Managing Committee. I thank everyone for having attended this seminar. I also request our chairman to inform the gathering here about the upcoming programs, and thank you so much.
Thank you.
Thank you, sir.
There is a query left from our past chairman, Avasara Srinivas Garu, in the chat box.
Okay, there's a chat box, there's a query.
Yeah, please. where in a case we have won the first appeal of a dispute tax liability, is required to be shown in CARO.
Sir, could you please read it out? Srinivas Garu, you are saying something, I didn't hear.
Yeah, this is our past chairman, Avasral Srinivas Garu. He posted a query in the chat box
Okay.
where in a case we have won the first appeal of a disputed tax liability, is it required to be shown in CARO even when the department goes for higher appeal?
No, sir, not required. Not required because the unrecorded income, it has not been established. The department has gone on an appeal, so department can continue to go on an appeal. But since in the first appeal, since the company has won the case and there is no undisclosed income, that unrecorded income that has been surrendered by the client, no reporting is required. Reporting is required only if unreported income has been surrendered in any tax assessment. So since when we win the cases, there is no undisclosed income that has been surrendered, the question of reporting the same doesn't arise at all. So succinctly to say that it is not required to be reported.
Okay, sir, thank you. Yeah, Chairman, sir, over to you. Sir, Chairman, over to you, sir. Query.
Sir, unmuted, sir, have you asked anything?
So, sir, the query has been explained by Guru Prasad Garu. It is done, sir. Now you can continue.
Sir,
The query was answered by the speaker, Sri Gurumurthy Garu, Guru Prasad Garu. You may continue the session, sir. Now, announcing the upcoming programs.
He handed over the proceedings to you, sir.
sir, Sridhar గారు ఏంటి చెప్తున్నారు?
సార్ వాసవద్ గారు మీది అన్మ్యూట్ లో వాల్యూమ్ తక్కువలో ఉన్నట్టు సార్. క్వరీ ఆన్సర్ చేశారు సార్ గురు ప్రసాద్ గారు. మీరు సెషన్ ఐ మీన్ ఐఎమ్ హ్యాండింగ్ ఓవర్ ద ప్రొసీడింగ్స్ టు యూ సార్.
ఒకసారి మన వాసన చెప్పేసేయండి. అదే ఆయనకి వినిపిస్తున్నట్టు.
హలో
సార్ అయిపోయింది, ఆ క్వరీ కూడా ఆన్సర్ చేశారు గురుప్రసాద్ గారు.
చేశారు చూసారు. ఓకే క్లోజ్. ఓకే. See, tentatively the program of the bank audit is announced on 17th. That is decided. That is a full day seminar on 17th. That program is there. Full day seminar. So another announcement I want to make is this. I request all the members to pay the one-time fees that decided in the earlier meeting, that 6,000 rupees per year and 3,000 rupees per the chartered accountants passed within the 2 years. So 50% concession is given to the young chartered accountants. So that is 3,000 rupees. I request all the members to inform all our friends and see that early payment is made, so that we can chalk out our programs, etc. Because this is month of March. So again, this one-time payment will be covered from April onwards, April to 31st March. So I request all the members to pay the one-time fees. And this is at the 12th program, some 2 confirmations have to come that I am eagerly waiting for 12th. So that is also virtual, but subject because I am waiting, because subject is the topic is NPA recovery of systems of NPA and regarding the ARC, DRT, IBC, SERVAC are total that system, because we are going for the bank audit, branch audit. So these stages of the recovery, what portion we have to take these for the creating the provision, etc. So it will be useful. So that he has not yet confirmed that. So I am waiting him. Once they confirm means definitely there will be a virtual seminar webinar on 12th evening. So we are eagerly waiting for this confirmation. So and 17th full day program is there. These two things are there. So with this, I think once again we are thankful to this Guru Prasad Garu, and we are going to seek in physical seminar also with you, sir. We want your help and this entire year, not only this subject, the entire year. Thank you very much, sir.
Sure, sir. Sure. Thank you very much.